Okay, good afternoon and welcome back everyone to our OptionsPlay Growth Lab series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be taking a bit of a step back from our program that we typically do every single Thursday, where we focus on looking at the practical applications of how to manage your portfolio. And what we're going to do is we're going to take a step back and we're going to look at some of the mechanics of how to actually achieve profitability, because ultimately that's what we're all here for, is to try to reach a point where we are confident in our abilities to be a profitable trader. So what I like to do before we get into today's session is to start by asking everyone a question. So if you could please bring up your chat window, which is at the bottom of your screen here. I'd like to ask everyone in attendance here a question with regards to how you approach your what you focus on, what you learn on in your path to reach profitability. So my question that I want to pose to you is, what do you think is the most important factor that determines your ability to become a profitable trader? And it's an open-ended question, because I'd like to see kind of what people want to focus their attention or feel like they need to work on in order to achieve profitability. Is it technical analysis? Is it fundamental analysis? Is it option strategies? Is it portfolio management? What is it that do you think is the most important factor that you need to work on to determine your ability to become a profitable trader? Please type your questions or your answers into uh, the chat window. Okay, so I'm seeing answers like option strategies for income, fundamentals, capital preservation, consistency and managing risk, technical analysis and options knowledge, effective procedure, how to manage a trade. Lawrence has one that I think is really interesting. Sticking to my plan once I open a trade, slash technical analysis. We'll talk a little bit about that today. Option strategies. I've got some answers with regards to what strategies they use, option strategies, options with fundamentals and technicals to manage risk, taking losses quickly, portfolio management, managing a trade. All right, so we see and I'm sure most of you can see the answers here. We see a very wide variety of answers, but relatively few um, answers that from my 18 years of experience from being a market strategist working with retail and institutional investors. There's one thing that very clearly differentiates profitable traders from everyone else, and not a lot of people answered that specific answer, which is why, if you look at kind of the statistics of like 70% of traders fail to reach profitability, I would say that the answers that we see from the answers that I'm seeing today reflect, the fact that I would say 70% of people are focusing on the wrong things, or trying to focus on the wrong things when they're trying to reach profitability. So that's what we're going to try to dive into today. Okay. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So, my goal today is to show you how to grow your trading account and become a profitable trader. That's the goal of the entire Growth Lab series. That's what we do every single Thursday, is to go through the practical elements week to week, looking at real trades together and showing you how to manage those trades towards profitability. But like I said, today what we're going to do is we're going to take a step back and we're going to kind of break that down, so that for those of you that are struggling with reaching profitability, we sort of lay out a framework for how to actually achieve that. And then every single week, what we do is going forward is we actually go through real examples and go through real trades and show you how to apply the framework and the theory that we're going to learn during today's session. So two things. We're going to look at understanding how to build confidence, understanding how your emotions influence your behaviors that contribute to wins and losses, and then consistency, how to build the ability to stick to a plan regardless of the current market conditions or current open positions. I saw quite a few people answer that they have trouble sticking to their trading plan. We're going to talk a little bit about why that happens and some of the things that you can do to to deal with that, if you will. Okay. So let's talk a little bit about the trader process. And this is based on, my 18 years of experience of working with retail and institutional traders, and just generally what I have found to be the case in my process of working with thousands of traders over that period of time. I tend to find that most traders will focus the majority of their time. Specifically, these are traders that have not are not at a point where they're confident in their strategy or they're confident in their abilities to be profitable, right? Traders that are still in the process of either learning or trying to get to profitability. What I tend to find is that the vast majority of those traders primarily focus their attention on seeking strategies that give them some type of high win rate or some type of strategy that they can focus on, meaning they are predominantly focused on things like technical analysis, fundamental analysis, option strategies, trying to figure out what aspect of those things they can optimize or learn more about that can give them a quote unquote a high win rate strategy that they can basically become profitable if they were to follow that strategy or follow someone else who has a strategy that they can follow to reach profitability. That's where I see the vast majority of traders focus their attention on. And if you can relate to that, please type 1 into the chat window, or this is where you currently feel that you are getting stuck on, as you are, trying out different technical indicators, you are trying out different parameters for different technical indicators, you're trying to learn fundamental analysis, you're trying to learn different types of option strategies, trying to figure out what option strategy gives you better results or higher win rates. If this is where you feel that you currently stand, type 1 into the chat window. And you see there's plenty of ones here in the audience today. Here's the thing. I was guilty of this when I first started trading, as I was focused a lot on technical analysis. I was trying out all types of different indicators, trying out different combination of indicators, trying different parameters indicators, back testing those indicators, trying to see if I can find some combination of a strategy that would be, if I were to trade this specific strategy, I would be profitable in the long run, right? I would say a lot of people spend a lot of their time doing that. And there's absolutely nothing wrong with that. But the reality of what happens is that after you spend hours and hours, days, weeks, months trying to learn strategies, trying to optimize, trying to backtest, trying to reach a strategy that you feel is going to be profitable in the long run, what happens once you actually start trading? Once you start placing trades and once you start seeing those P&L numbers tick up and down, the reality is that once you place real trades, which indicators you use, what parameters of indicators you use, what the overall strategy is, all of that goes out completely out the door once the emotions of wins and losses start taking over when you're in a real trade. Meaning, no one looks at a trade that's down $1,000 and remembers which parameters that they're using and thinking about the parameters and whether they use the right parameters and whether they use the wrong parameters and whether the parameters are still valid or not valid. Everything, all of that goes out the door when you're looking at a trade and you're down $500, $1,000, $2,000, or if you're up $500, $1,000. The emotions take over at that point. What your strategy was almost becomes irrelevant at that point. And what you end up doing, and this is something that is seemingly repeated universally across the board, regardless of what market you're trading, what strategy you're trading, whether you're trading options or futures or forex or stocks, whether you're trading a technical strategy or fundamental strategy, a universal application that I have seen as a market strategist is that people hold on to losers for too long. They typically double down on losses, potentially blowing up big holes in their portfolio. And what they do is they take profits too early. And it really doesn't matter what your underlying strategy was when you entered the trade. Universally, people tend to hold on to losers for too long and take profits too early. If you can relate to that, please type 2 into the chat window if that makes sense to you. If you have spent many countless hours optimizing strategies, learning strategies, trying to learn as much as you possibly can about the markets, only to have emotions completely take you over whenever you're placing a trade where what the strategy and why you entered the trade is virtually irrelevant in terms of how you decided to end up managing that trade. Because at that point, emotions completely take over, right? And I see a lot of 2s because, like I said, this is probably pretty universal from what I've seen. It really doesn't matter what markets or what your strategy is. I see this over and over and over again. So let's talk a little bit about overcoming emotions, because the vast majority of traders that say that they're not profitable or they're struggling with their their strategy, cannot quite identify what the problem is just yet. And I think, based on my first question, when I ask people, what do you think is the most important factor that determines your ability to be a profitable trader? I got all kinds of answers that really are somewhat irrelevant to actually what actually differentiates profitable traders from everyone else. So if you don't understand the problem, if you're focusing on the wrong thing, unfortunately, you're just going to continue to go down this spiral of continuing to struggle. If we're trying to fix the wrong thing, then we're never going to fix the the underlying problem. And that is at the core of why I think the vast majority of traders continue to struggle to reach profitability. Is because we're just focused on the wrong problem. We think that the problem is our strategy. We think that we just haven't learned the right indicators or the right parameters or the right settings for those indicators. We haven't mastered fundamental analysis yet, or we haven't learned enough about option strategies. We think that that's the problem, but that's not the problem. The problem is the strategy isn't the issue. Why you enter the trade is not the issue. It's your mindset. It's your ability to manage your emotions that is the core of why we hold on to losses for too long and we take profits too early. And until we can identify the correct problem, we can't fix the underlying issue, because there's a fair amount of randomness built into the markets, and this is something that I think a lot of traders fail to understand, because everyone that's focused on technical analysis and fundamental analysis and option strategies just feels that if I just learn more about that stuff, I will be able to better identify stocks that are going to move higher, or where I'm not going to have as many losing trades. But the reality is that losing trades are part of trading. The quicker you can realize that, and the quicker you can realize that, and a good example of this is, let's say you buy a stock because it crossed above the 200-day moving average. On any given day, there could be 20 stocks that crossed above the 200-day moving average. Which one do you buy? Well, it's sort of random as to which one of those 20 will end up outperforming by a huge amount. There's only so much information that you can look at, and there's ultimately limited information that you can look at. And the reality is that you can't tell the future. So stop trying to tell the future and stop trying to beat yourself up for not being able to tell the future. The quicker you can realize that, the faster you're going to be able to fix the problem, because the problem is not your strategy. It's not your indicators. Yes, those things can help. Those things, the more you learn about those things, the better you can be at picking stocks. But that's not what's going to make the difference between a profitable trader and someone who struggles, because someone who struggles is simply focused on the wrong thing. And if many of you here probably feel like you've been struggling for potentially years. You've probably gone from one strategy to the next strategy, from one subscription service to the next subscription service, and every single one of these pivots that you've made, or strategy changes that you've made, none of it is fixing the core problem, because the core problem isn't the strategy. The core problem is your mindset. It's your ability to manage your emotions. So if you look at kind of what profitable traders focus on, it really comes down to two things. Number one, what they do is they cut losers incredibly fast. And how do you cut losers fast? You have to sort of emotionally detach yourself from a trade. You can't get emotionally invested in every single trade. And that's what people who struggle with do. They tend to get emotionally invested in trades, and they don't want to accept the fact that they could be wrong, or that their strategy is basically gave them a bad pick. But that's the reality of it. And don't take it personally. It's somewhat random. It's not because your strategy sucks. It's not because you haven't learned enough. It's just random. So if it's just random, then you have to learn how to detach your emotions from the trade. So if you look at profitable traders, what they do is they cut losers incredibly fast, meaning when the trade that they think is going to play out doesn't play out, the first thing they do is they get themselves out. They never let losses grow. They keep losses as small as possible, and they do it ruthlessly. They don't put a lot of mental thought into it. They don't think about it. They don't spend a lot of time investing in a specific losing trade. They just cut their losers and move on. And you know what? Guess what? Sometimes they cut losers and it comes back and it ends up would have been a profitable trade, but that's random and there's nothing you can do about that. So the faster you can wrap your head around that, the faster you have the ability to potentially become a profitable trader. The second thing where profitable traders spend the vast majority of their time is they nurture their winners, meaning they look at where their views ended up being correct. And that is where they press their advantage. And we'll talk a little bit about what that means and how you go about doing that, because this is actually where you should be spending the vast majority of your time. So when I ask that first question, what do you think is the most important factor that determines your ability to be a profitable trader? It all comes down to how you look at your winning trades and how you nurture those winning trades, potentially to try to hit those home runs. If you can focus on that, I promise you, it doesn't really matter what your underlying strategy is, whether you're using technical analysis, whether you're using moving averages or RSIs or MACD or fundamental analysis or statistical analysis. It doesn't really matter why you enter the trade. If you can manage your winning trades successfully and nurture winning trades into home runs, that is what is single most important factor that's going to determine whether or not you are a profitable trader or not. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And it's okay if you're looking at me and you're saying, well, that sounds nice, but I have no idea how to do that. Well, that's what we're going to discuss next, is how you can actually go about doing that. But the first thing that we have to do is understand what is the problem. If we can't identify the right problem, then we're never going to solve the problem. Okay. The problem is not your strategy. It's not your indicators. It's not what you're using to determine why you're buying something. It's how you manage your trades, and more importantly, how you manage your emotions once you're in a trade. Okay. And someone mentioned the best loser wins by Tom Hogarth. That is arguably probably one of the few books that really hit in on this specific problem that unfortunately, I think not enough traders talk about this. That's a discussion for another day, but lots of people talk about technical analysis and fundamental analysis, and that stuff is really sexy, but not enough people talk about really truly what differentiates successful traders from everyone else. So let's talk about 3 rules. 3 absolute bulletproof rules that you cannot violate if you want to be a profitable trader. 2 of them are pretty simple and pretty straightforward. That's the first 2. Number 1 is position sizing. You cannot be profitable if you don't size your trades correctly. I just flat out, if you're not doing it, you cannot reach profitability. I can almost guarantee that. So the first thing you have to do is make sure you size your trades appropriately. And what that means is that whenever you have an initial idea means that you're placing a trade for the first time in a specific idea. So you watch TV, you're on social media, you subscribe to something, someone gave you an idea that you think is a good idea and you want to act on it. That initial trade should never risk more than a fixed percentage of your portfolio. And that generally should never exceed 2% of your total portfolio value. Meaning, whenever you're exploring an idea, never risk more than 2% of your total portfolio value on exploring that idea and initiating an initial position. Now, OptionsPlay as a platform has a tool that can help you do that every single week. And this is something that we talk about on OptionsPlay. So whenever you're using, let's bring up a difference. Let's just say, for example, ARC today generated a signal, or let's look at, hold on, let me just refresh the page. Excuse me. It doesn't really matter what symbol we look at here. Let's not look at a Canadian symbol. Let's look at some, what's a good symbol for today? Let's look at Dollar Tree, for example. All right, so Dollar Tree, this is a stock that recently generated a sell signal here today. You know, the stock has basically started to move a little bit lower here. It rallied, and the idea is that maybe this continues its bearish trend, right? So let's say we're looking at buying a bearish put spread here. We're looking at buying the December 105.85 put spread here. Before you click trade, before you go ahead and decide that, okay, this is a trade that I want to do, the first thing you should really be using is the risk and investment calculator inside of OptionsPlay. The risk and investment calculator allows you to set defaults in your profile, right? And I recommend every single customer that has an OptionsPlay account to go to your profile and set your portfolio risk setting. Basically, what this does is it calculates for you the appropriate number of contracts every single time you place a trade. So for example, it's default to 2%. So that rule is already preset for you. The only thing you have to put in is your portfolio value. Whether you have a $50,000 portfolio, a $5,000 portfolio, or a $5 million portfolio, put in your portfolio value, save it as default so that every single time you are looking at a trade in OptionsPlay, you just click on calculate and we'll calculate the number of contracts that you can trade so that the maximum risk of the strategy will be under the $2,000 mark for my $100,000 portfolio. It doesn't matter what strategy you're looking at, it will always calculate the appropriate number of contracts for you to trade. So you can always have the accurate number of contracts that you can trade. So for example, if I was looking at selling this call vertical instead, it's telling me I can sell 2 contracts and my max risk will be $1,500 for the 2 contracts that I've sold. So it'll always calculate the appropriate number of contracts for you. That's rule number 1. It's a really simple rule. And, you know, over the years, I've always gotten emails or people have told me, hey, you know what, you laid out a bullish or bearish thesis on this particular stock. I followed that idea and I lost so much money on that particular trade. You know, your idea was terrible. And my first reaction to that is, sure, the idea didn't work out. But when you say you lost a ton of money or you lost too much money, unfortunately, the only person you can blame, as much as you want to blame the person who came up with the idea for coming up with an idea that didn't work out, ultimately, if you really want to look at this and be introspective and if you really want to fix the problem wasn't the idea. The problem was how much size you decided to commit to the idea. And that is only something that you have control over. I don't have control over that. And whoever is giving you ideas or suggestions or recommendations doesn't have control over that. Only you do. So whenever you place a trade, if you end up, quote unquote, losing a ton of money or losing too much money, the person who gave you the idea is not the person to blame. The only person that you can blame is yourself. And the faster you can accept that, the faster you will put yourself onto the path of profitability. So stop risking too much money on their first trade. I will show you when you should be risking more money on your trades. But when you first, because every idea when you first initiate it, whether or not that works out is somewhat random. So always start by risking no more than 2% of your total account value on an initial trade. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. It's a really, really simple rule, and you need to follow it every single time you place a trade. It should be muscle memory. You should never, ever, ever get to a trade ticket without first calculating what is 2% of my total account value and calculating the correct number of contracts. You need to commit this to memory. You need to commit it to muscle memory so that every single time you place a trade, you're doing exactly this before you look at anything further. And if a trade you're looking at, if let's say one contract exceeds the 2% rule, that means you should not be trading that idea at all. So let's say your maximum is, let's say $1,000. Let's say you have a $50,000 portfolio. 2% of that is $1,000. And let's say you're looking at a Netflix trade or a Costco trade where a single contract costs $4,000 or $5,000. You should not be trading that because now you're risking 4 to 5% of your total account value on that one trade. Learn to stay in your lane for your account size, right? So if you have a $50,000 account, you just have to know that there's a limit in terms of what you can trade. You can't trade every single trade when you have a $50,000 account. When you have a $500,000 account, you're going to have a lot more opportunities to trade. So stay in your lane, and position sizing is the number one rule with regards to your making sure that you reach profitability. Because if you can't keep yourself from blowing up your account, you're never going to reach profitability. And if you exceed 2% regularly in your portfolio when you're trading options, I can almost guarantee you that you at some point you're going to blow a big enough hole in your portfolio where reaching profitability, statistically speaking, is going to be virtually impossible. Charles asked a question: Is it 2% of your total portfolio or the amount of cash available? We're talking about 2% of your total portfolio value. Okay, 2% of your total portfolio value. The second rule is cutting losses ruthlessly. And this is the part where most traders that I find that are struggling with profitability spend nearly most of their time on is focusing on their losing trades. They spend all their mental energy and time on quote unquote trying to fix their losing trades. And I know this because I get asked a lot of questions. Someone will give me a scenario. I bought this stock. I did this strategy. It's down, $500. It's down 50%. It's down 90%, whatever it is. And the question is, how can I fix this, right? What adjustments or what can I do to fix this losing trade and turn it back into a winning trade? People spend way too much time on their losing positions. Losing positions is the market telling you that your views on a specific stock or market is incorrect. You should just step away from those. You should not be spending a single moment more thinking about a losing trade, because that's where you should be cutting those losers and moving on. And arguably, this is probably where people emotionally have the biggest trouble of stepping away and crystallizing a loss and accepting the fact that their views are incorrect. And there's a lot of reasons for this emotionally, and I don't want to take away from that. I don't want to just brush away from the fact that it's hard to cut your losses, but this is what you have to do. And if you have trouble, cutting your losses when you should, my best advice to you is just set a stop loss. Where there's no decision that you have to make personally to actually to take on a loss. It's automatic. Until perhaps you can get to a point where you can emotionally detach yourself from a trade. And there's a good question, what happens when a stop loss depends on days to expiration? Well, that is a good point. But I will say, when a stop loss depends on days to expiration, it's not that often that you end up having to manually close out a trade because of days to expiration. It doesn't happen that often. But when it does, that is where it does require you to take on, some level of active management. And to do it, you can't just 100% make it passive, but you can make it, 90% of the time passive, where it's just a stop loss. And if it gets triggered, it gets triggered. If it doesn't, you let the position sit there. But there is no way that you can reach profitability if you don't cut your losers ruthlessly. Because if you spend all of your time mentally thinking about your losing trades, you're not focusing on the right thing. You're not focusing enough attention on where you need to be focused on, which is your winning trades. Now, how many of you can relate to that? How many of you feel like you spend so much time on your losing trades? Type 2 into the chat window if you feel like you spend a lot of time toiling and thinking about and mentally just consuming with your losing trades. What to do with your losing trades? How do you fix losing trades? If you feel that that's the space that you're in, please type 2 into the chat window. Okay, I see some twos, not a ton of them, but I see some. And if you are, and I see someone saying not anymore, thanks, Tony. And I hope that, for those of you that have been following me for long enough or have been members at OptionsPlay for long enough, you've learned to kind of change that mindset. But I can tell you, if you don't change that mindset, there is very little chance that you can get towards profitability if you still spend most of your time focused on your losing trades, because this is really where you should be spending the least amount of your time. This is where the market has proven your views to be incorrect, and you should be stepping away from those as quickly as possible, because the quicker you can step away from your losing trades, the faster you can focus on nurturing your wins. What I mean by nurturing your wins is by simply pressing your advantage where you have been proven to be correct. And an analogy that I always go back to is imagine Thanksgiving dinner one year. And I'm speaking to kind of the people that are living in America at this stage. And I know that many of you are around the world. So maybe I'll use something that's more universal. Let's say you're sitting at Christmas dinner with your family, or you're with your family at New Year's, something that's universal, right? Where you're together with your family. It doesn't really matter what holiday it is. And you're at a holiday with your family, and let's say you have two family members that approach you. Each of them has a business idea, right? And you think both, you get pitched these ideas, and you think both of them are great opportunities, and they're asking you for $10,000 each. So you decide one year during holidays that you're going to invest $10,000 in each of your family's members' businesses. You have no idea which ones are going to be successful, so you're willing to just take a bet on your family. So you give each of your family member $10,000, and then fast forward a year later, the next Christmas, one of those businesses is thriving. It's doing incredibly well. And the other business is really struggling, right? One business is doing really well. The other business is struggling. And those same two family members come back to you the next year and ask you for another $10,000, and say one family member saying, hey, I've been doing really well. We're growing really fast. Would you like to invest another $10,000? And maybe this could be really worth something big, in a few years, right? And then the other family member saying, hey, I'm really struggling. The business isn't taking off. Can you give me another $10,000? Maybe I can turn this around, right? Think about that scenario, because that is the scenario that you're in when you have two trades in your portfolio. One's a winner and one's a loser. When you put it into the context of businesses that are really doing really well and family members, I think it's pretty obvious as far as where you should be placing your additional $10,000, the next year. Should it be the business that's taking off and really doing well, or should you keep sinking another $10,000 in that family member whose business is not really successful and is really struggling? I think most people have a clear answer as to where they would place, an additional $10,000. But when it comes to their trades, we tend to do the exact opposite, right? We fail to put in another $10,000 in the trades that are actually winning. We keep throwing good money after bad money on the losing trades, hoping that we can turn those losing trades around. But in reality, you should not give your family member who's struggling another $10,000. You should let that business die maybe, and let him move on and do something else instead of continuing to struggle. And you should put your $10,000 in the business that's doing really well, because that's your opportunity to turn your $20,000 maybe into $1 million. That is where, it's not a perfect analogy, but it's the closest analogy that I can really come up with that gives you a better understanding of where you should be focusing your money and your attention on. Because where your trades are profitable, that's the market saying that, hey, your view is correct. press your advantage and throw more money at where the market has proven your views to be correct. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. That you should be focusing your attention not on any losing positions, but on your winning positions, and not just focusing on your winning positions, but putting more money at capital at risk on those winning positions. And that third part, arguably this nurturing win part, is the hardest part to do, emotionally speaking, right? Because let's say you put on a trade, the trade's up $1,000. What do? Our natural reaction is to take profits and lock in those profits so that those profits don't evaporate. Because it feels like if you, let's say you got into a trade, it's up $1,000, and you don't take profits in the stock, and it goes back to break even though you didn't lose money on that trade, that hurts. That seems to hurt us more emotionally, because we knew that we were at some point up $1,000 because we didn't take profits, and now it's back to break even. For some reason, even though the net result of that is zero, that hurts us emotionally more. And we're emotional beings, and it really, really bugs us if that happens. So what do? Sometimes before it even reaches $1,000, it gets up to $200. What do? Even though we think it's going to go up to 1,000, as soon as it gets $200, $250, $300, we say, maybe we should take profits, because what if I don't take profits and the stock drops and I go back to break even, or even worse, I lose money on the trade? So what do? We consistently take profits too early. I can't tell you enough how emotionally difficult this is. So cutting losers, like I said, black and white rules. It should require minimal energy. The message from the market is that your views are wrong. Get comfortable with the fact that just 40, perhaps even 50% of your trades are going to be wrong. And the faster you can accept that, the faster you will put yourself onto the path of profitability. Where you need to be focusing on is adjusting your winners, because as the market confirms your outlook to be correct, this is where you want to be adding exposure instead of taking profits, doing the exact opposite of everything what your body is telling you to do. Your emotions are telling you to take profits and run. But what you really should be doing, what profitable traders do, is that when their trades are proven to be correct, they add more exposure. Does adding exposure mean that there's the risk that this profit that you have turns into a loss? Absolutely. That is the risk that you're taking. If you're not here to take risks, you probably shouldn't be trading. But what you're trying to do is you want to take risks when it makes sense to take risks. And it only makes sense to take risks when the market proves your views to be correct. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. This is all about taking risk in the right places. You don't want to just take risks randomly. You don't want to take risks when it's a bad idea to take risks. You want to take risks when everything is aligned to when you should be taking risks. And that is when the market proves your views to be correct. Okay, so giving a winning trade the opportunity to continue to hit a potential home run, that single opportunity to hit a home run is what differentiates profitable traders from everyone else. Because profitable traders will keep putting themselves in positions where, when every single time their views are correct, they add more money to that trade. They're basically, instead of risking 2%, they might risk 4% now, right? You put on a trade, the trade goes in your favor. Instead of just now you might add another 2% to that trade, because now what you're trying to say is, okay, I'm trying to hit this home run, and I can try to maybe turn a 4% risk into a 10% return. And if I can actually get a 10% return, that's going to offset 10 losing trades in a row, right? Doesn't happen very often that I get to hit a home run, but every single time I hit a home run, I'm going to offset 10 losing trades in a row. And if I can do that consistently over time, where every single time I have a losing trade, I'm risking, let's say, 1% of my total portfolio value. Every single time I hit a home run, I'm making 10x, maybe 12x, 15x on my trades. If I can keep doing that over and over again, it doesn't matter what my strategy is. It doesn't matter whether I buy it because of the 200-day moving average or the RSI or fundamental analysis. It doesn't matter what your strategy is. It's how you manage your profitable trades that will determine whether you're a profitable trader in the long run or not. So yes, you risk turning a small win back into a loss, but that is where you should be taking risks. It's all about where you should be taking risk and where you should not be taking risk. So a single home run should offset at least 4 to 5 losing trades, if not significantly more trades. So it's a numbers game at the end of the day. Profitability has nothing to do with win rate, has nothing to do with your strategy, has nothing to do with probability of profit. It all has to do with whether your winners in terms of dollar amount offsets the losers that you have. You could have one big winner against 10 losing trades and still be profitable. So it doesn't matter how many winners you have, how many losers you have. You just have to have the winners be bigger than the losers. So the arithmetic to arrive to that is incredibly simple. The emotional journey that you have to go on is much more difficult to deal with, which is why, you know, it's already difficult enough to deal with this if you know what to deal with. It's completely impossible if you still think that the problem is your technical analysis, your fundamental analysis, because you're just outright focusing on the wrong problem. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And, you know, I've been teaching this for at least 7 or 8 years, you know, in my 18 years of trading, where I've really focused on trying to teach people this concept. And, you know, I ultimately, probably 70% of people who are viewing this today will still continue to struggle with what I'm teaching. And that's the reality of it. But for the 30% of you that really take this on and change what you focus on, it's life-changing in terms of how you approach trading. So I'm hoping that I reach more than 30% of you, but if at the very least, the 30% of you that choose to change what you focus on, this is the framework for how you go about doing this. And I hope that you come back next Thursday, where I actually go through real trades and show you real examples of how we cut losers and how we adjust our winning trades, because this is all about you know, today what I'm here is to teach you a framework, but we're here every single week to help you actually show you how to implement it. Today's session is really just kind of opening your eyes on figuring out what is important, what you should be working on. And every week we come back and we actually go through, we're in the trenches with you on these Growth Lab series, and we go through real trades and real examples and show you, okay, here's a losing trade, here's what we do, here's a winning trade, here's what we do. And we go through real examples every single week to eventually build the muscle memory so that it becomes less emotional and it becomes much more mechanical and a process that you follow. Because once you turn it into a process, that's where everything clicks. That's when you realize that it doesn't really matter whether I buy using an RSI or a stochastics or a MACD or a moving average, or whether I use a 200-day moving average or the 100-day moving average or the 21-day moving average. It really doesn't matter ultimately. If you can, it's really a matter of consistency in terms of strategy, and then focusing on the correct process, which is making sure that you size your trades correctly initially. If you size your trades correctly initially and you cut your losers when you should, and focus your attention on your winners, that is where you put yourself onto the path of profitability. And I will say, adjusting winners, it's an art. It's not a science. There's a lot of different ways that you can do it. There isn't one way to do it. You know, probably the most common one is probably a fixed percentage. So what that means is that, like, initially you have a trade, you get in, you risk 2% of that trade. If the trade starts to go in your favor, maybe you add another 2%. And if it goes in your favor, maybe you add another 2%, right? So that's just a fixed percentage adjustment on a trade, so that by the time you're, you know, you like the trade is really starting to work out, you now have 6% of your total portfolio's value at risk on that one trade. But those are the times where you should be looking at scaling up, right? What I tend to find a lot of people do, and many people might relate to this, right, is you have, you know, 3-4 winning trades in a row, and all of a sudden you think, oh, I've got the perfect strategy. I've now have 3-4 winning trades in a row. I've got this. So now all of a sudden, instead of risking 2% of your portfolio, you say, I'm going to risk 5% of my portfolio now. But that's not where you should be scaling up your trades. You know, you're just thinking like, oh, I've got a few winning trades in a row. I've got this strategy down. Let me scale up. That's the worst. That's not where you should be scaling up. You should only be scaling up when a trade is working in your favor, not just because you've had a few winning trades and you think that this strategy is a bulletproof strategy or a high win strategy. I'm just going to keep scaling up and I'm going to be, you know, turn my $10,000 into $100,000 overnight. That's where you're scaling up in the wrong places. And that's where I feel from my experience, scale up incorrectly. The other thing you can do is obviously a fixed dollar amount every single time, or for the very advanced is pyramiding, right? So meaning some people will start their positions with 1%, and as the trade goes in their favor, they'll add 2%, and as it goes in their favor, maybe they'll add 3%, right? And they'll scale up that way. So you can there's many different ways that you can skin this cat in terms of adjusting winners, and this is the work that we do every single Thursday, is to go through real examples and real scenarios to show you how to go about doing this. So with that, that covers what I wanted to share with you here today. I really hope that for those of you that are watching this today, that most of you are able to take on at least a small portion of what I laid out during today's session, especially if you're really serious about fixing your problems in terms of struggling to reach profitability. I hope that this illuminates to you what the real problem is, and that it gives you a understanding of what you can be focusing on with regards to as far as what you should be focusing on your attention on in terms of managing your positions or managing your portfolio so that you can put yourself onto profitability.